3, 2, 1, live! Yes, we're live. Ernie here with the Trader of Futures. It is Friday. Not that that means much to me. Friday's like any other day around here. Well, let's go to the talking head shot. There we are. And yes, it was another winning week for the AI setups. Another blowout week. And we are currently in a trade that, from last night, going short the EMD, which is the S&P 400 futures contract. We had, 5, 6 winners, no losers this week. I think that's what it was. So that makes, I believe right now that is 21 winning weeks. Winning weeks. I was just wondering if you could say that really fast, if it is a tongue twister. But I don't think so. Winning weeks. Yeah, it is. Say it 21 times, because that's how many winning weeks that we've had in a row. I think going on 135 trading days with only one losing day. So when others are talking about hypothetical situations, everything's hypothetical. We must do a disclaimer. No, that's real. Real performance. Now, I don't say that that's going to happen in the future, but considering the past track record so far, things are looking up. So that's where we stand. And somebody's asking me, "Oh, how's your bear flag doing on Bitcoin now, Ernie?" Nah. I fucking give a shit. Bitcoin, Schmitcoin. Bitcoin is the Schmitcoin Schmitta. So today, besides talking about the AI setups, we are going to continue our talk on what it takes to be a trader, to be a systematic trader, how to get your shit together. And that has been kind of the overall focus. Now, the AI setups is a fantastic tool, a black box tool for anybody that wants to be a systematic trader, because it takes care of perhaps the most difficult part of trading, and that is coming up with strategies that work, and coming up with an overall methodology, a philosophy around that. And then, so all you have to do is that once you have the setups, the entries, the exits, is concentrate on the execution. Now, I'm not trivializing the execution. The execution is a big part. It is so big, I've given this kind of anecdote, and I've seen it happen before, where you have a fantastic trader and you put somebody else on that trader to follow their every move. The fantastic trader does what they do. They do fantastic stuff, and then the other trader doesn't do so well. And that's because they don't have execution down right. They don't have their position sizing down right. They don't understand the concept of margin. So those are the things that you need to concentrate on. They also don't have a bigger game plan in mind, how they're going to go about this business of trading. And quite frankly, this game plan idea is really no different than if you were going to start any business. So if you're looking to get into business for yourself or whatever, your family, doesn't matter. Everything that I'm going to talk about today will apply to organizing your business and making you or giving you the best chance for success. So, and the reason why is that trading is in fact a business, and so there is this universal concept of how to get your shit together. I mean, I'm sure that there are many different ways, but this is a tried and true method. It's used across a wide range of disciplines, not only in the execution of a business, but also project planning, software development, business planning, trading. and it is all born out of some of the concepts of agile processes. I don't know if you're familiar with that. If you've ever been into software development, then you probably know something of what I'm talking about. I happen to be and was for many years a process and agile expert. There are some process types, one of them called Scrum. I'm a certified Scrum Master, for instance. And this process is all predicated on basically two things. One is to, I'll say three things. The first is that we time box everything. We give everything a certain amount of time to do stuff. Right? The next thing is that we only do what we can handle. And we try to break it down into bite-sized chunks and then do that over and over again. And then the third thing is the idea of a continuous improvement concept. So that if you've ever heard of the OODA loop, for instance, so that in this time box thing, near the end of that time box, or this circular thing, this repetitive process, you do this retrospective where you concentrate on improving what you did, what you learned over that time period. And I call this campaign trading. In business processes, they'll call this agile. A specific type of agile might be Scrum or Kaizen, which is another. So, yeah, there's this, and in fact, this has also been used, and probably the progenitor to all of this, in manufacturing. In fact, the Toyota manufacturing process developed something called Kanban, which again is this sort of time-boxed, small units of work, continuously putting them in there. Everything needs to work. Otherwise, you stop the process and fix that one thing. I mean, there are other concepts that come into play into the Toyota manufacturing process that is a little bit more involved, but it is all pretty much the same thing. Again, the main elements is time boxing. Don't bite off more than you can chew. Do that thing, that amount that you can chew continuously. Don't let it stop you. And then at the end of that time box, do a retrospective. Put into place what you've learned so that that becomes sort of like the input to the next cycle. So that's, I'm going to turn off this heater. It's starting to beat up a sweat. So, so that can be used in virtually any kind of business process, manufacturing process, project management, development process, your trading process. I call it the trading life cycle. And you saw that thing that I had drawn before. Drew it on my tablet here. Do it right here. We can go back and take a look at that. This is a more detailed process that kind of fits inside of this bigger thing that I called the campaign trading, right? I said that there was this sort of overlapping thing and that's that time box. That in this case, I've chosen a time box of 3 months. So when I put something in the show, these strategies, when I put them to play, they're in there for 3 months. along with the amount of capital that I want to allocate, and any other high-level ideas about what I want to accomplish in that 3 months. And then everything goes. It churns. The strategy factory is churning out strategies. The curation bin or the curation thing is curating. The show is executing the strategies that I've put into play. At the end of that process, I evaluate everything that I did, all the different aspects. And then before we start up the next campaign, we take what we've learned. We develop some kind of remediation if necessary. We decide what needs to be changed, kept the same, how we can improve, set goals, etc. Reset, and then do it all over again. In software development, they've taken this down to an art where they can, if you've done any kind of software development or a project plan in business, sometimes they're protracted, 6 months, a year, 2 years long. And that's the way software development used to be. The problem was every time they got 3/4 of the way into the project plan and they're getting ready to deliver the product, they find huge amount of bugs, or it doesn't fit the needs of the customer, and they have to go back and they have to do changes, and then there's overruns and overcosts, and it's just a big clusterfuck. And I haven't read or been involved in a single project plan that works like that has ever not had to go back and do some rework or extend. Very, very rarely. I mean, I would say that 95% of all projects never meet their goals. And that's because we try as humans to try to figure out everything that there is to figure out, all the unknowables up front, and then commit to them. And the only way that we can actually meet those goals or meet the time commitment is to sacrifice the quality commitment or sacrifice the price commitment. So you have price, quality, time. Those are three, tied or related aspects of any project. And you can't give up one without the other. What you can do is you can create the project and resize it so small that the predictability becomes almost a certainty. How small is small? Well, in trading, I think that you can't get much smaller than, say, 2 or 3 months. I like 3 months. In software development, you can create a usable, valued piece of software in about a week. Some go 2 weeks, and then deliver that to the customer. All tested, ready, deployed, go. And you deliver value. So that's what it's all about, delivering value with a minimal amount of mistakes. Also, when you bring this process down to a smaller, manageable unit, you start realizing what is value and what isn't. And while you can have a big picture in mind, now you have the flexibility to be able to alter that big picture or go into directions that are necessary as you get further and further, as you learn more and more about that process. This is what agile development and agile processes are all about. It's what made the Toyota Manufacturing Company the most profitable automobile company on the planet. It's the thing that has transformed software development, and it is currently the thing that is transforming business processes and the way people conduct business and communicate inside of enterprises. It's what made Apple what it is today. They had all these small groups that concentrated on small projects. They acted like a hive. So now we're talking about these projects and how they scale, but you're just an individual, How do I do one of these things? Well, I gave like the outline, the guts of this process but not, you know, the big picture part of it. And that's not too hard, that big picture part. The big picture part is pretty simple. So you have this, first of all, over here, you have things that you want to do. And maybe this is a stack of things. Big things, small things, real big things, medium-sized things. These are all the things that you want to do, and they have to get churned into this process, this cyclical process. What am I doing here? This whole thing is your, 2 to 3 months. Every day you have another process inside of here. Every day that you start, each day you have work to do. And then at the end, you have another process. This is your retrospective. This is your daily. This is your campaign. And you produce something. In the case of here, it's, you produce a P&L. So this is the more the generic thing. But in the case of, say, a business, you're producing, I don't know, a product. Or a piece of the product, whatever. So this is how it works. Now, what you put inside of there, the specifics, that's up to you. That retrospective is extremely important. That retrospective is also part of this input. You have a big input here when you start. What you get out of that retrospective is part of what goes into that input when you start that campaign. So you start this campaign by, first of all, deciding, what you're going to do, how much money you're going to allocate to your trading, what strategies you're going to trade, what parameters that you want to set in terms of your risk, and so forth. Maybe there's a bigger strategy in terms of market condition or seasonality or whatever. And then you kick it off. And then each day, you review what needs to be done. You go into your backlog. This is your backlog here of things to do. So hopefully all this kind of makes sense. All right. Let's see. We'll go a step further here. So one of the concepts that I brought up a while back was, remember I talked about multiple non-correlated strategies. You had all these strategies, and you had to see that they had a low degree of correlation. I said you could use the Correl function in Excel to look at the returns and then see how they match up with each other. And if those strategies, these all represent strategies that matched up. Our AI takes care of a lot of this part, by producing those strategies for you. Our AI right here is a strategy factory. Remember I said that when you have a bunch of non-correlated strategies, each of these are representing a strategy and the returns that they've had over a period of time. Etc. Some of them have, some of them might not be perfect. They might have drawdowns. Some might have big winners and then flatten out. Some might just go steady as they go. Some might not be such great performers. But when you add them all up, the drawdowns get minimized and then the profits get additive so that you create a much more low volatility equity curve like that. I'm going to show you an example of that in a second. This is all kind of review. So in this case, this is a more developed strategy or process or campaign for someone who is doing everything by hand, or if you have a big team or a hedge fund or something like that, where they have this strategy factory where they have people devoted, and it could be an individual as well. I mean, if you're an automated trader or a systematic trader, where you're devoted to just coming up with new ideas and then codifying or putting these things into a simulation and let them run and curating them and watching them over time. And then the ones that graduate, you put them into the show, you put them into play. And of course, this whole thing, the whole thing goes in the context of this big campaign, this agile process. Seems like a lot, I know. But this equals success. Now, our black box takes care of these two big things here. The AI setups takes care of all of that. It just pumps out strategies, and you need to put them in here and trade them. So the AI version of this with the AI setups, the black box AI strategy factory. It's continuously throwing in strategies in here for you to trade. every day. All the time. Never stops. Sometimes you might have 3, 4, 5 going at a time. Just keeps on throwing them in. And they're all different. Each one of them almost virtually guaranteed because of the way the system is set up, the way the black box is set up, to be non-correlated with the other. And so what does that mean? From a risk mitigation point of view, that means that you don't have to worry so much about individual stops on these because they tend to hedge one another. It's not saying that you shouldn't put stops, but you can put very, very wide stops on them. Big, huge stops. Unlike what you're doing now where you're trying to keep a tight stop. And then you can have maybe a portfolio size stop in case, a whole bunch of strategies seem to go the wrong way at some point. But that's a very rare occurrence. It happens about 1.5 times a year where you have maybe up to a 10% drawdown on this black box. The rest of the time it's humming along. Some strategies might not do so well. Some do pretty good. But as I said in the beginning of this show, I said, since we've had the system open, since it's been in operation since October of last year, it's 21 straight weeks in a row of winning weeks. Now, that doesn't mean that every strategy was a winner. It doesn't. Some of them were losers, but there were winners on top of that made up for those drawdowns. Overall, they were winning. 134 out of 135 days winning because of this strategy, this idea. All right, so I'm going to show you something that I created as a test to test seasonality. Now, while it's important that strategies are different, it can also be equally as important that the assets are different or the market is different, because you can apply a similar strategy but with a different configuration that is more conducive to that market, and you can get the same kind of low degree of correlation in the returns. And so an example of that is seasonality. So a while back, what I thought was, well, man, what if I could take a whole bunch of different assets, different future products, and see whether or not they had some form of seasonality associated with them. So in other words, is there some season where in the S&P 500 where it's best to buy and in another part of the year where it's best to sell? On average, over the past 20, 30 years. What about agricultural products? You might think, well, that makes a lot more sense because agriculture is dictated by real seasons. And so there is there as well. Of course, with the S&P 500, I'm sure many of you have heard of the, sell in May and go away, and then you come back in October for another day, right? It's kind of an anecdote, cliche. But when you apply this strategy, you find out that the strategy, when it's trying to find out over the long term, that anecdote plays out, that it is best to sell in May and then buy back in October. And there's seasonality to a whole wide range of things. It exists. And the equity curves are real. I mean, they are fairly strong. Not all perfect, but pretty strong. And so I did this experiment and came up with a really, really simple strategy. It's all codified here in this right here. And this was done in TradeStation. You could do this in NinjaTrader or just about anything else. It's really super simple. So basically, you have a buy month and a sell month. All right? So it tries to figure out when's the best time to buy and when's the best time to sell. And if you want to, you can put a filter in here. In this case, I didn't even bother putting a filter. I just didn't put a filter in. a filter could be some kind of stop loss. So I employed a moving average filter that seemed to work well. I've employed a chandelier strategy as a filter, which is a kind of ATR-based strategy, which actually improves the overall performance of these and keeps you out of the market a little bit more. Because, who wants to hold a market position for 6 months when you don't have to? But even if you had to hold a market position for 6 months and an asset went against you, when you traded all of these things together, they still did well. So basically the way this works is I defined the month, I defined what a moving average was, and then if I had a filter, I would use this. In this case, I would just say, okay, the filter's true. And what I would do is I would look at the moving average of the particular asset represented by C. C is the closing price every month. And then I would do an average over a long period of time. And whether or not that average was bullish or bearish. In other words, whether the average pointed up or pointed down. That's how I determine bullish or bearishness. So if the moving average pointed up, it was bullish. Otherwise, bullish was false, or otherwise it was bearish. And so I would say, okay, if the buy month is bullish, then buy. If it's a sell month equals when you should sell, when it's bearish. Otherwise, it's the alternative case. Super simple strategy. So here's where I applied it. And I applied it across all these different assets. So here we have an upper left is natural gas, and then wheat, corn, gold. Down in the lower left, the euro dollar. Here, right down here, the 30-year bond. Then the S&P 500. And over here, soybean. I mean, those are really a set of diverse assets. And you can see that, there was periods of the year where they were red, meaning that they weren't making money, and periods of the year where they were making money. That's the blue bars. So red bars are not making money. Actually, it's the other way around. The red bars mean that it's in a short. The blue bars mean it's in a long. All right? And then down below here is showing when it's either making money or not making money. So you can see that sometimes we had red. This guy here, natural gas, wasn't making money. Wheat wasn't making money. Corn was making money. Gold was making money. The euro was making lots of money. The bonds were making money. The S&P 500 was making money. But soybean wasn't making money. So you have all these positions that are on. Some are long, some are short. And so what happens when you take? Now, some of these equity curves, in general, over the long period of time, they were pretty good. Some of them weren't so good. Some of them had big dips. They went all over the place. But when you added them all up together, this is what you got. This is the equity curve you got over a long period of time. Looks pretty good. And there was an area here where it was pretty flat for about a couple of years. And that can be expected. And we can improve this by adding that filter, by the way. But that's showing you. And then this next chart is showing you how I looked at the correlation between them all. So here's all the different assets using the seasonality strategy. And then you can see it. All of them have very, very low degree of correlation. And so remember yesterday I talked about correlation, and the day before that anything under 0.5 was considered pretty good. You can see that there was really only one at 0.49 that was near 0.5. The rest were really low. Not bad. And of course, here's what I drew for you a while back. All these different processes. Here, what I'm showing in the live campaign, I'm showing how you would scale it by just increasing the number of strategies that you would put in place at any one time, or maybe the size of the strategy, the size of the positions. That would be another way. The curation, and as it drops down, moves in to the campaign, to the show. So there you saw a real strategy, super simple. Now imagine if you had a whole bunch of these super simple strategies that were running. Long-term strategies are far more easy, way easier to get positive results over the long term. And that's why I was doing monthly. I could have done weekly, and that would have been okay too. A lot of people are trying to develop strategies, and people here, I'm sure, are like, man, I gotta trade every day, and that's the way I make money because I can feel it. But it's not. The longer term your strategy is, the better chance that you have in actually being profitable. So I was just illustrating a very long-term strategy, and it was profitable, very, very profitable. So if we were to go back to this guy here, this here, each one of these things again is enveloped in the big, the big process, the big campaign, right? Remember the big campaign. This guy. All of that is all sitting inside here. This is sort of like the time clock, just going through one big 2 or 3 month campaign, and every day I do work, and I take some more off the backlog and do more work. That could be the over here in strategy development. In this type of process, you spend about 70 or 80% of your time in development, coming up with new strategies, and then putting them into curation and monitoring them. But with the black box, you don't have to do any of that. The black box doesn't do that. It shortcuts the method. It shortcuts it dramatically. So you only do this, and you don't even do any of the black box work. You just wait for things to come into the show. But if you wanted to get into each one of these aspects, we could do that. I have, laid out here what the development cycle looks like and all the different things that you need to do. And notice it's a cycle as well. This is another cycle inside the cycle. Coming up with new strategies, coming up with a new idea or hypothesis, model it, do in-sample testing, do out-of-sample testing, deploy it to the simulation or the curation bin. Then what do you do when you get in curation? Again, another cycle. Things come into the curation bin, you categorize those strategies. You group them by low correlation. You figure out the proper position sizing. You monitor them. Then you deploy them. When you deploy them, they go into the show. What strategies are you going to put in there? How much capital are you going to allocate? The start date. Log everything. Prune. But this is the big picture campaign. This is like the big picture. I don't know. You might find this interesting. Or not. Maybe I just wasted all my time talking about this shit. But this is how an institution works. This is how professional traders work. This is how hedge funds work. This is how it works. And fucking Asdirt, well, fuck you, because you're gone. Asshole. Nobody's going to come in here and tell me what to do. So fuck you and the goat you rode in on. Ernie, stock's not looking so cheap. Who cares? I don't care. I don't care what stocks look like. I'm not a value investor. Make money going up or down. Vanjara asked, does the AI setups have risk parameters? Well, you may have missed about what I was talking about. When you trade them all together, they have a natural hedging. Do they have risk parameters? Yes, the black box is churning them out with the risk in mind. The more of these that you can trade, the better. The more risk mitigation that you have. You can put very loose stops on them. I wouldn't put tight stops on them. It makes no sense. Say hi to Bob Kraft. Yes. What do you think about this rally in BTC? Still sell the rally? You're serious, right? You're calling that a rally? It's a little bit of a rally. And as everybody knows, my position is to sell every friggin' rally. I don't know that I call this a rally. There's a couple of pumps in it. I said that I was prepared to do 4 or 5 pumps and add to it as we go up, starting off with 1/5 of a position size. That's right, Chris. I've got the band hammer. I like that. It's the band hammer. Fuck them. Just, fuck them. They're here to do nothing but just spread bullshit. That's right. And that's exactly what I thought. They're robbing people of value from these live streams. I spent too much time addressing their bullshit. No more. Gurdip, another person that just needs to learn. Bitcoin bottom is in. What the fuck does that mean? Because it's gone up just a tiny, tiny little tweak, and all of a sudden you're saying the bottom is in? You don't have a picture. You don't have a view of the big picture. And it's really too bad. Well, thanks, AMS991. I appreciate the fact that people are in here and want to see, What I'm showing you is you don't get this type of information. This type of information is fucking gold. This is the type of presentation that I would be giving to corporate customers for a shitload of money. Now, I've brought it down to a different level, but so that it's not hard to understand. It's not as intricate, and it's certainly right in line with exactly what an individual needs to know. Well, that's exactly right, Chris. That's exactly what the trolls are looking for. They're looking for me to respond to them. And I wanted to see how long I could go on with this, and I had decided a long time ago that I wasn't going to deal with it anymore, but I'd been a little bit too patient. And so I apologize to other people for not being quicker with the band hammer. So that's the way it's going to be from now on. We're not going to let bullshit ruin the party. Just get rid of their asses. We don't need them. All right, so the AI setups, like I said, this week, 4 big winners. This week a winner, last week a winner, the week before that 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 was a winner, the week before that and 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 that were also winners. So I'm telling you now, price ain't staying the same. We are talking with some introducing brokers. We have started with one already. They really love what they see, and I plan on, if that is a successful relationship, I'm going to go to many others. I think we've proven, that this service is really valuable, and now it's time to move on to the next level. Why do Bakkt and Fidelity keep delaying their crypto exchanges? See, here's the thing, Gerda. What they're doing is they come out with these big announcements hoping to see if there's going to be some kind of traction. They want to be the first ones on the block. I understand that. When there's no traction, when there's no real something there for them, right? They have the money to be able to throw shit like this at it, Let's do a trial. Let's do a test balloon. Let's see if it, see if we get some traction. And if they don't, no big deal. I mean, I've gone through this so many times, just, showing you exactly what kind of involvement there is in enterprise, in investing in this technology. And it's fucking minuscule. Nothing. Nobody's investing anything in it. Sure, you can go and look at the niche players to the right websites, and it seems like there's a lot going on. But big picture, when I take a look at jobs that are available in the Boston area, the San Francisco area, or anywhere else in the world, it's really nothing. Nothing. So why invest all your effort into that is so risky? If it is going to be something, it's going to be there in the future. In the meantime, do something that's real. Tried, trued, been here for decades, centuries. Nah, you'd rather follow the thing that is just mired in fraud and malfeasance, Ponzi schemes, corruption. It makes no sense. Now, I'm not saying that there won't be something at the other end of the tunnel for crypto. There will be. Maybe. Maybe in a year, maybe 2 years, maybe 10 years. I don't know. But no time soon. Absolutely no time soon. So why waste your friggin' breath? Makes no sense. All right. We're moving up on 50 minutes. I want to thank everybody for the time that you spent here. Please give it a like down below. Share this video with your friends. Put it out there on your social media. I'd really appreciate that. This is really valuable content. Next time I'm going to go into some of the more particulars around volume profile. And maybe at some point I'll address a lot of the individual aspects of trading, the statistical aspects, keeping good logs, trade plan, that sort of thing. But for now, thank you very much. Take care. Have a great weekend. Bye.